welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Jim Leavis, Head of Retail Fixed Income for M&G. Hi Jim.
Hello.
So I thought we'd start with the Fed raising rates last month. Of course, it's not a new subject, but the way the markets have taken it means that it constantly renews itself. Insofar as when they raised rates last month, the consensus view was that there's going to be another 4 to 6 rate rises throughout 2016. And already there's been a lot of backpedaling on that, and people are saying 1, 2, maybe even a cut. Where do you sit on that?
It's quite interesting that immediately after the Fed hiked rates, markets were really well behaved. Somebody even produced T-shirts that said, "I survived the Fed rate hike of 2015. I think they sold a lot of those, and people want their money back by now as we come into January and equity markets are in bear markets. And rather than 4 rate hikes priced in for 2016, the markets rolled that back really aggressively. So perhaps 1 from the Fed, nothing from the Bank of England all year. And, we're in a kind of depressed mood where we think that the world is going to fall off a cliff economically again. I think there are lots of reasons to be cheerful and to say it is right that the markets have taken away some of the Fed tightening that it had in. But at the end of the day, the oil price has halved for almost 2 years in a row now, and that will have a massively stimulatory effect on the global economy. So the US jobs market's still very strong, cheap energy, those are the good news stories that mean that eventually the Fed will be able to raise rates again, but it won't be as quickly as the market had thought it was going to be back in December and earlier.
I suppose what that means is bad news for savers, those individuals who really hope they're going to get a bit more for cash, but actually good news for bondholders who have had a pretty good run of it, and that may continue for another year.
Yeah, it could well do. You've seen government bond yields be really quite stable despite the rise in expected interest rates around the world. You still only get 2% for investing in a 10-year US Treasury bond, and it's quite difficult to see why that would go up to 2.5%, 3%. The rate of Fed hikes, even though we are going to get hikes, the terminal rate, where the Fed ends up, where the Bank of England ends up, is going to be much lower than it ever was historically, and that means that the downside for fixed income is perhaps not as aggressive as the market may have once thought. The one fly in the ointment might be that one of the biggest holders of US Treasury bonds, of gilts and bunds, is the Chinese government, effectively. They've built up trillions of dollars worth of reserves in US Treasury bonds, and as the Chinese economy goes into reverse, although the numbers out today, if you call 7% growth, if you believe that a reverse, that's a nice place to be, but nevertheless, they are selling down billions and billions of government bonds, and that might be a thing that enables yields to drift slightly higher. So in my fund, the Global Macro Bond Fund, I still want to be underweight government bonds at this point, not just because rates are going up, but also you have this big persistent seller of government bonds going forward. I
suppose then the flip of that is, where do you want to be? If you don't want to be in US Treasury bonds, where are the opportunities?
Well, if you look at what's been the worst performing asset classes in fixed income world, it's been in US high yield bonds and it's been in emerging market bonds. And we've been heavily underweight those 2 areas for a very long time. And because in emerging markets, we've been waiting for the Chinese slowdown to come, haven't owned them. But when you see that Brazilian real is depreciated by 30, 40%, the bonds are yielding 15, 16, 17%, and that's true across all of emerging markets, I think that 2016, there will come a turning point when you say, actually, the oil price has halved from 100 to 50 to high 20s. Is it going to go down to 12? It might well do, but nevertheless there'll be an opportunity in commodity bonds, in energy bonds, and even emerging market bonds. We have Claudia Kalic, who I know has been on here before, talking about emerging markets. She works in my team, and there will come a time, she reckons we're 2/3 of the way through the sell-off in emerging markets, but hopefully there'll come a time in 2016 where you'll want to pull the trigger and say, well, I'm not going to get double-digit yields in any other bond asset class, and this is the time to invest there.
Jim, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.